Welcome to the Deep Dive. This is where we sift through all the noise, the latest articles, the research, and really just hand you the essential insights you need to actually know what's going on. Today, we're zooming in on one specific day, November 3rd, 2025. Our source material paints this really vivid picture.
It really does.
It wasn't just another Tuesday, was it? It felt like this triple collision point.
Yeah, a collision. That's a good way to put it. You had these huge forces hitting the crypto world all at once. You've got major tech convergence, intense regulatory pressure, and some really high-stakes political games.
All on the same day.
All intersecting. And that collision, it basically defines the environment we're in right now. So our mission today, really, is to give you the map, help you navigate this complexity. Because the sources, when you look at them together, they show a market that's, on one hand, showing corporate maturity. I mean, we're talking multi-billion-dollar deals.
Right.
But then, boom, deep regulatory shock coming from, unexpected places, political interventions.
Yeah.
And at the same time, this radical technological expansion that's fundamentally changing what a crypto company even looks like. It's not just about speculation anymore. Not by a long shot.
No. These feel like foundational shifts, structural stuff, things that touch energy grids, even presidential politics.
Yeah.
It's bigger now.
Absolutely. We're talking structure.
But when you stack these sources, what really jumps out is how tangled it all is. Like, you see these market moves kicked off by just one person's influence.
Yep, the power of the individual still.
Then you've got these massive corporate plays trying to weave crypto into traditional finance infrastructure.
Consolidation, yeah.
Yeah.
Big strategic moves.
And layered over all of it, this intense regulatory control, sometimes pulling in different directions, it seems, coming from agencies, but also, the highest political levels.
It's a messy picture.
Okay, let's unpack this. So let's start with that immediate volatility, the short-term stuff, because it's a good reminder, right? Even if things mature, one big name can still just dominate the narrative.
Oh, absolutely. Forget fundamentals for a moment.
We saw that with the Aster token. It just took off.
It did. A surge that you wouldn't predict from typical market charts. Aster spiked, what was it, over 30%, almost instantly.
Vertical.
And the cause was, it's crystal clear, no mystery. Changpeng Zhao, CZ, former Binance CEO, he just publicly stated, disclosed he'd bought about $2.5 million of Aster.
With his own money. Verified funds.
Personal funds, yeah.
Now, $2.5 million.
Yeah.
Okay, it's a lot of money to you and me, but in the grand scheme of a token's market cap, that alone shouldn't move the needle 30%, should it?
No, not directly. It's not the volume of the buy itself. It's the signal. That's what you hit on earlier.
Right.
That $2.5 million coming from CZ, it acts like this huge public vote of confidence. He's arguably one of the most visible, most influential people in crypto globally. Still. So for the retail market, and honestly for a lot of institutional desks too, seeing CZ make a personal bet, they often read that as him having some kind of inside track, maybe on future utility, future growth, something.
So it just immediately kicks off that whole debate again. The one we thought we were kind of moving past, about how much sway these big figures have.
Exactly. How do you manage that kind of influence in what's supposed to be a decentralized market? The sources really highlight this lack of a real firewall between what these guys say publicly and the direct, sometimes wild, market swings.
It's like an instant, almost artificial pump in liquidity, isn't it? And the conversation just erupted again. Should there be stricter rules? Like insider trading laws for CEOs in traditional finance. Should that apply here? Regardless of where these crypto leaders are based. Because if one person's tweet or a statement can trigger hundreds of millions in trading volume, that's market power. That feels like it should be in regulatory territory.
That's the tension, yeah. Where does influence become manipulation? But, okay, while that individual influence creates all this short-term noise, maybe distraction is a better word. The really big money, the multi-billion-dollar corporate stuff, that's looking much longer term. It's about infrastructure. So we kind of need to pivot now to what Coinbase was doing. Much quieter, maybe, but the implications far bigger for the whole financial system down the road.
Okay, yeah, let's shift to that, the foundational stuff. Coinbase is already a giant, obviously. So what was this key move they made on that day?
Well, the big news was this negotiation. Coinbase looking to acquire BVNK. They're a stablecoin and digital payments infrastructure startup.
BVNK, right. I remember them.
And the price tag being talked about is, it's pretty eye-watering for a startup in this space, around $2 billion. estimated.
2 billion. Okay, so that's not just like bolting on a small feature. That's a statement.
It's a fundamental transformation of what Coinbase wants to be.
BVNK was big in cross-border payments, right?
Yeah.
Especially business to business. I seem to recall that focus. How does buying that change Coinbase?
It massively expands their scope. They're moving beyond just being an exchange, a place to buy and sell tokens. Our sources make it clear they want to be a complete infrastructure provider.
Okay.
By bringing in BBNK's tech, especially their multi-currency stablecoin management and those B2B payment rails they've already built, Coinbase is trying to position itself as like the essential plumbing for digital payments globally.
So they handled the big stuff. Instant cross-border settlements for businesses, large volumes.
That's the goal.
Moving up the food chain.
Yeah.
From just collecting retail trading fees to providing this core utility and charging for that. They want to be the base layer for digital commerce.
Exactly. And this is crucial prep work for what we think are going to be the defining sort of platform wars of the next decade.
Centralized versus decentralized.
Pretty much. Will the world run on highly regulated centralized stablecoins, maybe run by giants like Coinbase? Or will it shift to more decentralized solutions? Either way, controlling the pipes, the rails, the liquidity pools, the settlement, that's the ultimate prize.
So this $2 billion bet is about owning that infrastructure. Making digital money movement instant, reliable, the kind of thing traditional finance needs before it can really jump in with both feet.
Precisely. It gets them ready to compete at that level.
Okay, so if the first part was about, corporate strategy and individual market movers, this next bit is pure turbulence. Political, regulatory, just, wow, two really big examples that hit the market's sense of legitimacy, its stability.
Yeah, this is where things got really wild. And the biggest story, the one that just stopped everyone in their tracks, it has to be the CZ pardon, the presidential pardon.
Here's where it gets really interesting.
I mean, the sheer audacity of it.
Yeah.
And the timing, it just sent shockwaves everywhere. Political world, financial world, everyone was stunned.
Yeah, former President Trump confirmed it. A full pardon for Changpeng Zhao.
Yeah.
And the detail that really stood out, politically speaking, was his claim that he didn't even know CZ personally.
Right, which makes it seem even more calculated somehow.
And the justification. What was the official line?
Well, according to the sources close to the decision, the line was that the president was convinced CZ had been unfairly targeted. Political persecution, basically. And crucially, the claim was the underlying case against him. Well, it did not constitute a crime.
Oh, okay, that's not just arguing about the sentence length. That's a direct challenge to how financial laws have been interpreted and the authority of the agencies that brought the charges in the first place. Radical.
Totally radical. And it immediately caused this massive political firestorm in the U.S. You basically had to pick a side instantly. So we need to kind of lay out both sides of that fallout impartially, because the market reaction really depended on which interpretation you believed.
Yeah, let's do that. What was the view from the critics?
The critics, they immediately slammed the decision. They said the former president was basically gutting the principle of accountability, especially in this fast-moving digital finance world.
Signaling impunity, basically.
That was the word used a lot, yeah. Impunity. Like a dangerous signal that if you're a big enough player, your legal problems, even serious compliance issues, could just be wiped away for political reasons. A major blow to regulatory enforcement, rule of law, maybe even separation of powers.
Okay, but then the supporters, they saw it completely differently.
Completely. They framed it as a necessary correction, fixing regulatory overreach or excesses by agencies from the previous administration. Some argued those agencies were like weaponizing regulations against an innovative industry they didn't understand.
So a rebalancing act, arguing the original case was maybe based on laws that didn't really fit crypto anyway?
That was the core argument, yeah, that the prosecution itself was flawed or politically motivated.
But regardless of which side you fall on, the bigger picture implication seems pretty clear, right? Source 5 really hammers this home.
Unavoidable. The pardon is being read almost universally as the clearest signal yet. A signal that a potential second Trump administration could mean a much, much softer regulatory touch for crypto.
Globally, even.
Potentially, yeah. Affecting global exchanges, how they plan, where they set up shop. That perception is now baked into investor thinking. It changes the calculation for compliance costs, for regulatory risk, everything.
Doesn't that just inject a huge amount of instability, though? Regardless of whether you think the pardon was right or wrong, it introduces this massive political risk. Exchanges operating in the U.S. or wanting to, Now they have to worry that a change in who's in charge could just erase years of compliance work or flip the rules completely.
It absolutely creates systemic regulatory instability. That's the key problem for businesses. They need predictable rules. This pardon swaps predictability for, well, political whim.
Right.
It turns crypto policy into this high-stakes election football. The industry's future gets tangled up in political cycles. That's a huge shift in market dynamics.
Okay, so while the U.S. is dealing with that bombshell, Europe was taking a different approach. More traditional enforcement, boots on the ground.
Yeah.
Let's talk about Polymarket. That's kind of the counterpoint here, isn't it?
It really is. A very different story unfolding simultaneously. The action in Europe, specifically Romania, shows that global regulatory pressure hasn't gone away at all.
What happened there?
The local gambling regulator just shut them down, blocked access to the Polymarket platform within the country. Direct, decisive action.
And they used gambling laws? For a prediction market.
Exactly.
Yeah.
They classified it as unlicensed gambling. The argument was simple. Polymarket was operating as a betting venue without the right licenses. And this wasn't trivial. The platform had apparently handled something like $600 million in contracts.
Wow, $600 million. Mostly on election outcomes and things like that.
Yeah, political events, election results, other future stuff. That kind of volume pushes it way beyond some niche tech experiment. It becomes a major financial activity that the state feels it needs to control.
And that definitional problem, is it finance? Is it gaming? Is it a prediction tool?
Yeah.
That's the headache for regulators everywhere.
Right.
Romania just decided it's gambling.
They did. And it fits the broader global trend we see in the sources. Governments are watching anything that mixes finance, gaming, and blockchain very, very closely. And that scrutiny is only expected to get tighter, especially in places like the EU and Asia, where consumer protection rules are pretty stringent.
So you've got this weird duality, potential softening, politically driven in the U.S., but hard enforcement and tighter rules pretty much everywhere else.
That's the landscape right now, a real push and pull.
Okay, now we get to what might be the biggest underlying story of the day. Structurally, I mean. It completely changes the identity of crypto's most basic industry, Bitcoin mining.
Yeah, this is huge. The great pivot, as some are calling it.
It's not just like tweaking the business model. This is a massive multi-billion-dollar shift in direction.
It really is redefining what a crypto company even is. The sources show this profound transformation happening across the board. Bitcoin miners are moving away from just focusing on hashing power for Bitcoin.
Which is their traditional role, securing the network.
Right, and they're becoming providers of high-performance computing infrastructure, specifically for the absolutely exploding demand from artificial intelligence.
Okay, that feels less like a slow evolution and more like seizing a massive opportunity or maybe a necessary pivot. Why now?
It's almost entirely driven by the AI demand. It's just, it's insatiable right now. Think about what these mining companies already have locked down. They've got huge power contracts, often for cheap electricity. They've got sophisticated cooling systems already built. They have the physical data center space. They have direct grid connections.
Right, assets that are hard to replicate quickly.
Exactly. And those assets are perfect for running the kind of intense, power-hungry AI models that need massive amounts of energy pretty much constantly. So miners are actively rerouting parts of their operations and, critically, their investment capital to meet that AI demand.
So their new job description is basically provider of energy and high-performance computing.
That's it. It's a fundamental shift.
Let's get into the nuts and bolts a bit, because this isn't just flicking a switch. Going from mining Bitcoin to running AI models. That's a big technical lift, isn't it? What's the difference in the hardware?
Oh, it's completely different. Bitcoin mining uses ASICs, application-specific integrated circuits. These chips are like race cars built for one track, incredibly fast and efficient at one single task, calculating cryptographic hashes. SHA-256 mostly.
Okay, purpose-built.
Totally.
Right.
But they're useless for anything else, especially the kind of flexible parallel processing you need for AI.
Right.
AI workloads, training large language models, running complex simulations that needs high-end GPUs. Graphics processing units, usually from NVIDIA these days. GPUs are designed for parallel tasks, which is exactly what AI needs.
So to make this pivot, the miners have to rip out the old gear and buy incredibly expensive new stuff?
Pretty much. It's a massive capital expenditure. They have to decommission billions of dollars worth of ASICs, their existing investment. Then they have to buy these very expensive, very hard to get NVIDIA GPUs, retool their whole software setup, often upgrade cooling and power delivery because GPUs have different demands than ASICs.
Okay, that explains the huge dollar figures we're seeing in these deals.
Absolutely.
And the market seems to love this strategy. Let's talk specific numbers because these contracts are just staggering.
Yeah, take Cipher Mining. The source mentions they signed a deal with Amazon Web Services, AWS. It's worth $5.5 billion.
$5.5 billion.
Billion, yeah. And it's not short-term. It's a 15-year contract to supply 300 megawatts of AI-focused processing capacity.
15 years. Wow, that basically makes them a core utility provider for AWS's AI cloud. That's guaranteed revenue, something Bitcoin's price swings could never offer.
It creates stability,
Yeah.
long-term value based on concrete assets, infrastructure, energy contracts, not just the fluctuating price of a token. And you saw the market react instantly. Cipher stock jumped, what, 19% in one day?
Yeah.
Investors immediately saw the value. Tying the company's fate to the AI boom, it massively de-risks the business model in their eyes.
But even that massive Cipher deal, it wasn't the biggest one announced that day.
Nope. Iron landed an even bigger one, valued at $9.7 billion, this time with Microsoft.
Almost $10 billion.
Astonishing, right? Microsoft plans to use Iron's energy infrastructure and their data centers for its own cloud services, specifically feeding those power-hungry NVIDIA GPUs running Azure's AI services.
So between just those two deals, you got $9.7 billion plus $5.5 billion. That's over $15 billion in contracted revenue, flowing from Amazon and Microsoft directly into companies that used to just be Bitcoin miners. That's validation.
Complete validation of this hybrid data center model. The logic for the miners is rock solid. They diversify away from their biggest risk, Bitcoin price volatility.
Right.
They monetize their most valuable fixed assets, cheap power and physical space, by selling them into the highest demand market on the planet right now.
AI compute.
So instead of riding the Bitcoin roller coaster, they're selling the picks and shovels, or rather, the power and compute, for the AI gold rush, which everyone expects to last for years.
That's the bet, selling predictable commodities, power and compute cycles. But again, we shouldn't understate the difficulty. It's a huge operational challenge. They have to shift from running one type of hardware, relatively tolerant of interruptions, to managing these complex, high-demand, low-latency AI workloads for picky customers like AWS and Microsoft.
Right.
Requires totally different skills, different systems.
And the sources suggest this isn't just a temporary thing. It's like the start of a whole new era, convergence.
Absolutely. That's the word, convergence. This signals that the future of crypto infrastructure is becoming less about the specific tokens and much more about the global digital infrastructure underpinning everything. You're seeing blockchain assets like the data centers and the energy deals merging directly with traditional energy providers and the massive AI compute market. It shifts the whole conversation from just DeFi, decentralized finance, towards something more like DCI, decentralized computing infrastructure.
Interesting. A whole new acronym. Okay, so given all this chaos, frankly, presidential pardons, $15 billion AI deals flying around, regulators clamping down, how did the actual crypto market react overall? Did it soar? Did it tank?
You know, despite the massive positive news on the AI front, the broader market was actually pretty subdued, cautious even. The main index tracking the top 20 cryptos actually dipped slightly, about 4%.
Down 4%. Interesting.
Yeah, not a crash, not a panic sell-off, more like a mild correction. Keep in mind, it followed a few weeks where prices had already climbed quite a bit.
Okay, so the immediate vibe was caution, people taking profits. Maybe the regulatory uncertainty, the political stuff, weighed more heavily in the short term than the AI exciting.
That seems to be exactly it. Investor sentiment stayed really guarded. People used all this news flow, the political noise, the big corporate deals, as a chance to lock in some gains and, importantly, to rebalance their portfolios. The instability from the pardon, combined with the threat of more clampdowns like Polymarket, that definitely fueled caution. Uncertainty tends to do that, even when there's good news mixed in. Capital gets defensive.
But, okay, within that slight overall dip, there was huge variation, right? Extreme selectivity, which tells us a lot about what investors are actually valuing now. Let's talk winners and losers.
Definitely. The big winner on the day was Internet Computer, ICP. It surged 35%, just huge.
35%. Why? What drove that?
Seems like it was strong institutional buying. The narrative was around new integrations, progress on its decentralized network capabilities. It really shows that the big money, the institutional capital, is actively rewarding projects, demonstrating real, tangible progress, especially in things like interoperability and actual utility.
And why ICP specifically, do you think, at that moment?
Well, ICP's whole pitch is building this decentralized cloud, this world computer. In a climate where the infrastructure layer, like the miners pivoting to AI, is proving incredibly valuable to big tech.
Right.
Investors seem to be looking for networks that offer similar, robust, utility-focused services, but without relying on centralized giants. So ICP's jump kind of signals this search for decentralized projects with solid tech and a clear use case. It fits that whole infrastructure narrative we just talked about.
Okay, makes sense. And on the flip side, who got hit hardest by this investor selectivity? Which projects lost favor?
The main losers mentioned were Sui, SUI, and Kronos, CRO. Both dropped around 9%, pretty much in sync, which suggests investors are actively sorting projects now. They seem to be moving away from coins perceived as having maybe less immediate utility or perhaps weaker tech fundamentals compared to the ones focused on clear infrastructure or interoperability plays. The market's just demanding more proof of value now. Promises aren't enough.
So the big takeaway here for you listening is that the game has shifted. Less appetite for pure hype, pure speculation,
Much less.
and much more focus on what a project actually does.
Exactly. This selective trading highlights that critical transition. There's definitely less hunger for just betting on the next big thing and way more focus on projects showing verifiable utility, how they connect with other systems, interoperability, and just solid tech foundations. The market's asking tougher questions now. What real-world problem does this solve? How does it fit into the bigger digital economy? The infrastructure story is king.
Wow. Okay, we've covered a lot. I mean, from a $2.5 million personal buy moving a token to a presidential pardon rewriting financial risk, all the way to a nearly $10 billion corporate AI deal. It's a lot to process. We need to tie these threads together now.
Yeah, let's connect the dots. If we step back and look at the bigger picture from all these sources, we can really boil down the events of that day, that collision, into four main trends, four clear forces shaping digital finance right now.
Okay, lay them out for us. Let's start with the tech transformation, the AI angle, given those huge dollar figures.
Right. Trend one, crypto and AI integration. This is fundamental. It's real. The former Bitcoin miners are aggressively pivoting. They're becoming these hybrid data center operators using their energy and infrastructure assets to power AI.
The $15 billion in deals proves it's not just talk.
Exactly. It's the leading edge of technological convergence. Blockchain's physical footprint power, compute, is being directly repurposed for the AI revolution.
Okay, trend one, AI convergence. What's next?
Trend two, stablecoin and payment infrastructure expansion. This is the Coinbase BVNK story. The big players, exchanges, fintechs, they're all trying to build and control their own stablecoin ecosystems and the payment rails underneath.
Right.
This isn't just about crypto trading anymore. It's about owning the future infrastructure for how digital money moves globally. And that sets up this huge battleground, regulated centralized platforms versus decentralized alternatives.
Trend two, stablecoin infrastructure wars.
Got it.
Trend three.
Trend three, continuous regulatory pressure. Polymarket in Romania is the perfect example here. Regulators worldwide are still intensely focused on anything that blends finance, gaming, and blockchain.
That pressure isn't going away.
No, if anything, it's likely strengthening, especially outside the U.S. maybe. They're demanding compliance, licenses, oversight for any of these hybrid models that gain traction. You can't just operate in the gray areas anymore if you get big.
Okay. Regulatory vigilance. And the final big one, the political bombshell.
Trend four, growing political influence. This is the CZ pardon effect. It confirms loud and clear that crypto isn't some niche topic anymore. It's a major high-profile political issue, especially in the U.S. election cycle.
Right.
And that political dimension now directly feeds into market behavior, into regulatory expectations, into risk assessment for every company in the space. Political volatility is now a core risk factor.
So putting it all together, what's the snapshot?
The synthesis, really, from Source 6 is that November 3rd captured this exact moment. Corporate maturity slamming into regulatory shock. You've got exchanges fighting over payment rails, while the miners, the heavy industry part, are making this enormous bet on merging with AI and energy infrastructure.
So the big takeaway is the future of crypto seems deeply tied to actual global digital infrastructure. Blockchain plus energy plus AI all working together now.
That's where the value is consolidating. The market's definitely prioritizing real substance, real utility, real infrastructure over just speculative hype. That seems undeniable now.
Hard assets, interoperability, utility. That's the new mantra.
That structure is where the serious money is flowing, where the long-term value is being built. And, that leads us to the final thought we wanted to leave you with, something to chew on. thinking about the sheer scale of that capital, that $9.7 billion Microsoft deal, the $5.5 billion AWS deal, all pouring into AI infrastructure run by former miners. What does that incredibly aggressive pivot tell you about how the smart money perceives the long-term value of, say, controlling energy assets and compute infrastructure versus just holding volatile tokens? Where's the real anchor in the future digital economy? What stands out to you?
It really reframes what digital wealth might actually mean long term. Owning the infrastructure, not just the asset that runs on it. Definitely something to think about. Thank you for joining us on this deep dive into that triple collision. We really encourage you to explore those ideas, utility infrastructure, further. We'll catch you next time to unpack the next big stack of sources.